Good evening, everyone. Welcome to today's webinar. And as you all know, that this webinar is on the new product, which is SIF, and we have invited, ITI fund manager here to explain ITI strategy. So first, let me, it's a new product, and we all know, a couple of months back, the SEBI introduced SIF. There was a structural gap between the mutual fund and PMS or AIF probably. So SEBI has introduced a new product SIFs, जहाँ पर आपको जो म्यूचुअल फंड में जो ट्रांसपेरेंसी है वो म्यूचुअल फंड की तरह ही मिलेगी, बट जो स्ट्रैटेजी है टिपिकली विच विल बी लाइक एआईएफ स्ट्रक्चर में जो आपको मिलता है. So this is a clear cut, gap filler kind of a product. And mutual fund, as we all know, we can start from rupees 500, while PMS 50 lakh का आपका cut off है, and AIF is 1 crore. SIF, the minimum investment is 10 lakh. So again, this from the investment point of view also it comes in between, जहाँ पर आपको 10 लाख में एक entry point मिलता है. Both the transparency like mutual fund, as I said, and the strategy of AIF. So this is a new product, and as of now, I think in couple of months, the these products actually garnered around 4,000 crore in a very short span. So let's understand today how Logic is managing a Divinity Equity Long Short Fund. Logic is having around 25 years kind of a experience on the fund management side, portfolio management, and on the fixed income market. And before ITI, he worked with a DSP and Derivium kind of a companies. So, sir, over to you, and we would like to understand overall product point of view and how SIF long short strategy you are running, and a different market scenario, what kind of a returns investors can expect from this particular product. So over to you.
Okay. Thank you, Ritu. Thanks for the introduction. So as Ritu has earlier mentioned about the, April 2025 onwards, RBI, SEBI has allowed this particular category, that is the specialized investment fund category. Uh, and then thereafter, from June, July onwards, people have started applying for it. We got the approval in the month of October, and where we have launched our November 2025 for the first Divinity long short strategy along with it. Okay, so here the logic behind the regulator to come out with the specialized investment fund, it is purely because of the mutual fund and in coming in between PMS and or the AIF structure. As she has already mentioned about Ritu, that PMS you have to have a 50 lakhs and above investment, and for AIF it has to be 1 crore and investment. Mutual fund you can start from the scratch right from 500 rupees, and then thereafter it is a perfectly a match between PMS and the mutual fund, whereby in SIF your investment has to be a 10 lakhs and above. Okay, it's a specialized investment fund represent more or less a platform for innovation and investments. The way you have seen the same or similar kind of innovations into the AIF kind of structures, with some modifications, you can do the same under the mutual fund, under the trust, and with much better taxation also. It will help you to generate a much better return. That's one. Two, at the same time, with innovative investment avenues, the way PMS and AIF can do it, okay, we will be able to do it even with a lower AUM, or to start up with a lower investment of 10 lakhs and above. So which gives me a provide overall a flexibility within the strategy, but within the regulations, and much better tax efficiency as far as framework is concerned. Okay, why much better regulations? Because as you're aware of the fact that mutual funds are very well regulated in itself, their disclosure norms has been well defined. We are all aware of the fact that last 25 years, the way our disclosures has given much better clarity about the industry, about the competition, about the portfolio, about the risk part of it. It is very well managed as far as risk management practices of the mutual fund has been really good at it. Okay, so as a regulator, they expect us also to manage the same and if effectively use the same strategy under the SIF in itself. So slowly and gradually, we are of the opinion that the tight regulatory landscape will help along with the taxation efficiency. My investment strategies, which is different, which will have a flexibility in itself, will be much better. And SIF is the one which is going to bridge the gap between mutual fund and the AIF part of it. So there is a key differentiation points which we have mentioned out there in this particular slide, where you can see the common factors like SIF and within the mutual fund is nothing but it starts with the taxation angle. Okay, like the way you have a mutual fund long-term capital gain tax, it's at 12.5% for the minimum holding of 12 months. In equity, it will be the same one like the way we have launched one equity long short, our LTCG remains to be the same or similar, like the way mutual fund holding would be. Debt and other LTCG is also exactly the way mutual fund holding would it be. Okay. The difference between AIF and the SIF strategy would be predominantly onto the, of course, one is about the minimum investment, as you can see in that presentation. PMS is 50 lakhs and above, AIF is 1 crore and above, and for SIF, it is 10 lakhs and above part of it. Okay. Here, the leverage component, that is no leverage is permitted the way mutual funds are. Like in terms of AIF, I can go and have a gross exposure all the way up to 200%. Okay, that is what has been allowed by the regulator in AIF, whereby in SIF it will be the exactly the same way the mutual fund works as far as leverage is concerned. There are no leverages are permitted under both mutual fund as well as in SIF. So that is where my portfolio exposure would always be up to 100%. It cannot be more than 100% at any point of time. Okay. Now, the derivatives component will be only used for hedging and rebalancing as far as mutual fund is concerned. Okay. But in terms of leverage part of it or hedging part of it, I'm allowed to do a naked short up to 25% of the portfolio. Okay, that is under SIF. So 0 to 25% is allowed under the SIF part of it. If I compare it with AIF and the PMS, there are no leverages permitted in PMS, but then leverage is permitted in AIF. But in gross exposure, as I mentioned, that it can go all the way up to 200%. And that 200% can be anything. It can be a naked short of 100%, it can be a cash equity 100%, and the combination can be in different permutation combination is allowed under the AIF, whereby in SIF it is allowed only up to the 25%. I'm allowed to do a short into the naked short position as far as short exposure is concerned. Now there are 7 structured investments that has been allowed under the 3 different major categories: equity, debt, and hybrid. Equity is there are 3 subsections like equity long short, equity X top 100, and there is a sector rotation part of it. Okay, here the gap is like equity long short is predominantly into the large and mid cap, where you can do trading activity in both as far as having a long exposure or having a short exposure part of it. X top 100 will be apart from NSE top 100 stocks. You can trade into the long short strategy, which will be predominantly mid and small cap kind of segment. Sector rotation fund, as you know, the name suggests, it is I can trade well within my own means. I can hedge my positions within the sectors and within the different sectors. And within one particular sector, I can hedge against the different companies as well. Debt oriented schemes is just a normal one, debt long short and a sectoral part of it. Hybrid is also again as far as it is like multi asset allocation fund, what it used to be like in mutual fund, it is the same way. My active asset allocation, which is a long short fund, and there is a one more hybrid long short fund which I can launch for it. So these are the 7 categories being allowed by the regulator for the SIF platforms. As a matter of fact, most of us who were like last 3 months, I think 5 mutual fund houses have SF guys have launched. They have been predominantly into the hybrid strategies and into equity oriented strategies. So Diviniti SF, that is the ITM mutual funds sponsored Divinity SF, has launched equity long short. That is a first category under the equity oriented strategies. Debt oriented strategies nobody has launched. There are still some clarifications are yet to be come from the regulator, mainly into the sectoral part of it. And in debt schemes, hedging mechanism is slightly difficult, and there are only few ways and means to do it, that is in OS or in IRF. But the activity in OS and IRF is limited to very few handful of instruments, like in 3 month OS or a 3 month IRF or 1 year IRF or in 5 year OS, whereby the limitations have been very well defined and regulator is also aware, and there are work which is going around with. If I go ahead and further, that my divinity, the name suggests, is nothing but divine plus niti part of it, which says about the integrity and about the universal wisdom, followed with the Indian philosophy of principle into the ethical practices, the moral governance part of it, and the strategic intent combined together is a divinity. That is what the captures the name stands for. The investment objective that I would like to highlight is a long-term capital appreciation. The one who's actually looking out for the capital appreciation or the capital protection is the one which can think about investing into the divinity equity long short strategy, whereby we will try to capture the market momentum, and at the same time we will try and limit the limit the downfall or the downside part of it by way of my short exposures in equity, either through derivative instrument or by way of hedging my mechanism, and at the same time by way of doing the short of my exposures. I just want to highlight, like in last 2 years part, okay, especially from January 23 to 25, we have seen first half, like till September 2024, we have seen only the one-way rally. Okay, it was like Jan 23 till September 24, we have achieved 26,200 Nifty by that time. First time that we have achieved the peak of 26,200. It was a one-way rally that we have observed. Almost 35% CAGR return were generated for, but then thereafter there was a quite a sharp correction into the Nifty, into the market, of almost in a span of 6 months by almost 3,000 Nifty points in intra-week part of it, which has also impacted the returns from January 23 to Feb 25. Now, just to highlight the combined returns generated during the same 2 year part is almost a 22% Nifty, whereby my long short strategy helped me to generate almost a 39-40% kind of return during the same period of 2 साल में. Okay. Now, first half, that is up to September 2024, if you could observe, our long short strategy has generated more or less same or similar kind of return the way Nifty has generated by around 42 to 44% kind of returns that we have generated in the up moving market, whereby in correction measures, whereby market has got corrected from October till February 25 in a span of 6 months, almost 5 to 6 months part, market has got corrected by 14% Nifty, and my long short strategy has corrected by minus 3%. This is what my cumulative returns has been much better compared to the Nifty part of it. My this particular phase of October 24 to Feb 25 has helped me to garner and accumulate a much better compared to the Nifty part of it. The logic and the explanation comes with the participating in upside market, okay, while limiting the downside risk movement during the equity market downward movement part. Thus, overall lower the volatility and lowers the risk component within the portfolio in itself. This is what we call it as, of course, asymmetric return profile. If it is not asymmetric return profile, if I could have remained to be long, okay, my Nifty return could have been got matched for my long short strategy, whereby it is not then called as a long short in itself. It could have been called only as a long only kind of strategy. This is what a different strategy will help me as far as long short strategy is concerned, to help me to protect the downside going ahead for. Now, let me give you the further example in terms of the long term, like we have talked about, it is a 2 year part of it. This is a 8 year kind of track that we have generated. Now, to give you a brief background behind it, like ITM mutual fund, ITF fund has been running AIF for last almost 7.5 years. So it's a same strategy that we have applied in our AIF strategy part of it. So all this data point has been collected from our own portfolio and the way we have managed our portfolio. So this is a sample back tested data, but it is based on our own portfolio that we have managed in our AIF. It's almost 1,000 crore book size right now, and the way we have managed for last 7.5 years gets reflected into our performance, and which shows in my presentation part of it. If you could observe, in last 8 years there were like four major corrections which has happened during the almost four times, we have outperformed the Nifty by miles. So to start with, we have observed like RNFS, credit crisis, which has generated almost a negative 10, 11% kind of return, whereby our long short strategy has generated only a negative by 2%, which we all aware of the fact it was a mayhem in itself. In a very short term period, it has like lost almost 26, 28%. Nifty has lost that much kind of returns were like negative in itself, whereby my long short has generated a marginal positive by 0.5%. Nifty, then thereafter, it has got recovered slowly and gradually, got settled all the way up to 2022. But there comes the rate hike cycle in a very short span of 10 to 12 months part. RBI has hiked by almost 250 basis point. Repo rate has moved up by 250 from 4% towards 6.5%. That has a negative impact on the equity market, which has generated almost a 10% negative return, whereby my long short strategy has generated minus zero point 0.3 kind of returns. We have seen and we have observed right from last year onwards, 2024 onwards, there was a outflow in itself by the FIs have been redeeming it from the India market. They have been withdrawing their investments from the India, and the returns were like almost 9% negative compared to my returns of almost 1.1%. This is a long-term track record that we have generated for last 7 years. If you could observe that the kind of downside protection has helped me to generate almost a 165% kind of return vis-a-vis the Nifty movement of 135% in the same period of last 7.5 year part of it. This is what a particular strategy can help me in terms of generating a much better return compared to the Nifty part of it. It will help me to protect the downside part of it. And the way we manage is nothing but the risk management measures. The way we calculate and the way we follow our risk part of it is what makes a lot of difference. Like the way you can see sharp ratios, which indicates a more or less towards the per unit risk factor for the portfolio at a portfolio level has been much better compared to the Nifty. Standard deviation is also on the lower side, which shows that there is not much of a volatility. Beta also shows that the 0.29 compared to the Nifty has been much, much better compared to the market movements, and which becomes less sensitive towards the market upside and a downside part of it. The Trenner ratio has been remained to be much better compared to the risk that we have been generating, the kind of returns that we have been generating over the market vis-a-vis the risk that we are taking has been much better, which shows that the calculative risk and the risk management measures helps me to generate a much better return compared to the Nifty part. Now, in this part of it, like what kind of downside risk or the management that we mentioned is like portfolio one, if you remain to be, it is a perfect example of remaining to be only long for a very long time. Like first 2 years, it is very green. Everything is so good to have a great return profile in itself. But if you remain to be long in the third year, whereby the corrections happens in the market, almost a minus 50% kind of, and the combined return would be fallen all the way up to 150 kind of percentage return vis-a-vis the second portfolio, which shows about the long short strategy. It will help me in the downside to be get protected, whereby in a downward moment of the third year, we will be able to capture the downside or protect the downside in itself, which will generate the combined 193% kind of returns over a period of 3 year of investment horizon. Here, our basic rule is like don't lose any money. And the second rule that we follow, that don't forget the rule number one. Now, all these last 5 years, especially from the COVID part of it, we have seen and observed that only a one-way rally in itself. Like we have seen right from COVID that Nifty has gone all the way below 9,000 kind of Nifty. And since then, it has been moving up above slowly and gradually. But it's been quite a steady upward movement. But at the same time, there was a period right from 2008 to 2013, almost a 5 year, it remained to be in a very narrow band of 6,000 to 6,300 Nifty, which has been very risky in itself. Why? Because if someone wants to redeem their money in the year, let's say in 2009 or part of it, whereby the yield or the Nifty has moved from 6,000 Nifty towards all the way up to 3,000, even if you remain to be invested for almost a 5 years part of it, the returns would be generated meagerly a single digit because the Nifty has ended at the same level the way it used to be. It was in 2008. So that's the kind of volatility that you can see within the same period of 5 years. But at the same time, it would be like a corrective measures, or it is like a what we call it as a time correction which happens, or a sideways kind of movement which we have seen, which we have observed. We have seen, if you observe, like even a way back in 2000 or a 98 to 2000 part of it, we have seen almost the same similar kind of movement in itself, and then there will be a reactions to it. This particular chart shows that even if you remain to be a 5 6 years long kind of returns would need not to be as good as the way we have seen it in last 5 years part of it. There can be a period whereby it is just only a sideways movement in itself, whereby the returns would need not to be generated as per the market expectation. So that's the one which need to be observed enough for. Now, right from September 2024, we have moved 26,200. We have gone below. We have got it recovered towards 26,000 kind of Nifty as we speak. But more or less, last 12 to 15 months, if you could observe, our Nifty remained to be in the band of 25,500 plus minus 500, more or less. So that is where also my last 1 year or a 15-month period return has been meagerly a single digit return, especially in a large cap kind of segment. If it is goes all the way down, that is in mid and small cap, and in small cap, it has been really a negative returns that has been generated at the stock level, at the index level as well. This is what a particular strategy of long short can start come into the picture and will help me to capture the downside and protect the downside and move along with it. If it moves from 3000 Nifty towards 6000, it will be able to generate some return, and at the same time it will protect the downside from 6000 towards 4500 as Nifty, as you can see in this particular presentation. So this is what we would like to say, that at a particular juncture, like as I mentioned, like last 15 months, we have seen 12 to 15 months that it has been moving in the narrow band of 25,500. Now, what is the logic for it? Like if you go ahead with investment into the fixed income, now fixed income also in last since the February 2025, we have seen and observed that rate cut cycle has started. RBI has been giving a lot of facilities. Fiscal push has also already been done. 6.5 repo has moved all the way down towards 5 quarter. Even if we are done, almost done, in my opinion, with rate cut part of it. But at the same time, rate hike is not certainly going to start in the next year itself. It can get a pause for another 12 to 15 months. So by way of investment into the fixed income, it is expected to generate only a low or a very declining return in itself, need not to be on a higher side. Similarly, on to the equity part of it, we have seen the valuations has remained to be elevated. It is adding towards more and more volatility. We have seen the kind of corrections. If it happens, it's been quite sharp enough, and the downside has remained to be very volatile in itself. That is where the SIF kind of strategy, which was provided by the SEBI, will provide the avenue to implement, hedging mechanism or such kind of strategy within your investment environment in itself. So to give you example further, in terms of what kind of, like as I've been talking about mitigate downside risk and to participate in market returns, I would like to instruct, like give you the information about the portfolio construct, how we are going to do it. Now, this particular strategy or a scheme that we have launched, it is a purely a equity strategy in itself, equity scheme in itself. So that is where my most of my equity and equity equivalent exposure will be in the band of 80 to 100%, whereby the core equity remains to be there, and long short strategy would always be there as a part of my trading and the investment strategy. Debt and component part of it, money market instrument, will be in the band of 0 to 20% part. The theme behind the debt is purely to create a liquidity within my portfolio and to have the hedging mechanism, to have risk part of it in terms of providing towards my, what do you call it as, for the margin purposes. Sorry, for the margin purposes. I'm sorry. So it is purely for the margin requirement. That would be the case for debt and money market instruments. REITs and InvITs, as we have been allowed to do it up to 0 to 20%, as far as by the regulation is concerned. As with launch of our scheme, REITs has actually become a part of equity investment in itself. So it is purely for the InvITs that we would be participating as and when opportunity comes out with. So it is purely only on the basis of SID to be mentioned right now from 0 to 20% for the REITs and InvITs part of it, but it is only at an opportunistically time that we will be investing into such instruments. Overall, for the hedging mechanism, the derivatives will be used for it, and up to 100% of the net asset that I'll be allowed to, which gives me flexibility to implement my risk management and about the improving the efficiency of the portfolio in itself. Overall, it will be investment profile or the portfolio profile will be get divided into the two segments. One is into strategic long positions, and another one would be tactical long or a tactical short. That is how the structure would be. Detailed structure as far as total longs are concerned, I will be doing a strategic long and the plus of tactical long. Strategic would be in and around 50-55% of the portfolio, and the tactical will be in the band of 10 to 30-35%. This is what I would like to mention, that how we are going to construct our portfolio going ahead as far as my Divinity equity long short is concerned. Hedge, as you know, that I'm allowed to do 100% of my strategic long. It is allowed by the regulator. I'll be doing it all the way up to 100% of my long positions. Short will be allowed up to 20%, 25% as far as regulation is concerned. And overall net exposure will be total long minus hedge minus short will be my net exposure in itself as far as portfolio construct is. Overall, this is like how we are going to do the strategic portfolio and tactical portfolio, as we have been mentioning about it in different market scenarios, whether it is a normal, bullish, or a bearish. We would like to keep our strategic long purely onto the 55% part of it, whereby the flexibility comes with the tactical long and the tactical short, along with the cash and cash equivalent part of it. Okay, in a normal condition, I would be having, as I mentioned earlier, about longs will be strategic will be 55%, tactical longs will be 10 to 35%, and a short will be 10 to 25%. Similarly, one thing that I would like to mention is my gross equity exposure will always be in the band of 80 to 100%, as it is a purely a equity scheme in itself. As I mentioned in my earlier slide, gross long will differ whether it is in normal condition, it would be in the band of 65 to 85% or a 90%. If it is extreme bearish, it will be on the lower side by 55 to 70% part of it, whereby my gross short will keep differing with it. If it is my bullish segment in itself, my tactical short will be on the lower side of around 0 to 10 or a 0 to 20% part of it. If it is a bearish part of it, my shorts will be in the band of 10 to 25%, as I have mentioned in my slide part of it. Let me go through further in terms of the range potential of my different investment strategies. As I've been talking about neutral, bullish, and the bearish part of it. If I could have been bearish in the same example whereby my strategic long will be a 55, but if I have a negative view on the market, as I can allow to do 100% hedge, I'll be able to do the 55% of my hedging. Tactical short can go all the way up to 25%, which is minus 25%, and a cash and cash equivalent will be 20%. With this, my net exposure will be minus 25% as allowed by the regulator in itself. Overall gross equity exposure, as I mentioned, has to be in the band of 80 to 100%. That is how the structure would be, whether it is for bearish segment or for the bullish segment, like in a right side example, whereby in a bullish segment, I will be going a strategic long as 55. My tactical long will be almost up to 40%, and the short will be almost zero because I've been allowed to keep it up to 0 to 25%. And a cash and cash equivalent asset could be in the band of 5 to 10% part of it. So that is how the net exposure will be in the band of 90 to 95% part of it, as and when I will have a very ultra bullish view about the market. This is what we would like to capture, that if the market is moving up above, then we will be able to participate almost 90-95% of the market part of it by way of this particular strategy. And at the same time, if I have an ultra bearish view, I'll be able to do the downside protection by way of having a net exposure almost towards minus 25%. This is what will help me in terms of protecting the downside in itself. So this is one particular strategy in both ways that I can manage I can be able to maneuver well within my own means. In a neutral condition, as I've been saying, that it can move from 30 to 50% kind of net exposure. Overall gross will be in the band of 85-90% part of it. Hedging mechanism will be up to me to manage within 10 to 20%. Similarly, tactical short will be moved into the 10 to 20% kind of stuff. So this is what a range potential can be possible. This is what can help me to protect the downside part of it by way of going all the way up to net exposure minus 25. And at the same time, I can capture the rally by way of having a almost 90-95% to be on the long side, either in strategic long or by way of tactical long. I'll be able to capture the nifty momentum as and when it is possible to capture with. If I go ahead with a further, like the way into the way the construct would be, or the way my risk management also the practices will help me in terms of a typical gross equity exposure, as I've been mentioning in my other slides, that it will be in the band of 80 to 95%. Long equity is in the band of predominantly into 55 to 75%, and the short will be up to 10 to 25. As the overall short exposure is allowed only up to 25, so there is a limit for it that I can go ahead with it. Overall net exposure will always be in the band of 40 to 60% overall in terms of the typical way of managing this kind of strategies. In terms of a single security exposure as allowed by the regulator, it is up to 10%, whereby we would like to keep it up to 8%. So overall, a typical single security exposure will be in the band of 2 to 8%. And at the same time, a typical short exposure in a particular security, even if we are allowed up to 10%, we will like to keep it maximum up to 4% for a short exposure on a particular security level part of it. Why? Because again, we really don't want to get towards the skewed portfolio in itself. We really don't want to expose our portfolio only towards only 2 or 3 extreme bets as far as shorts are concerned. That is where my risk management practice will come into the picture. That is where I will have my risk mechanism comes and have a restriction towards one particular extreme short positions, which will help me in terms of reversal of the market if it goes wrong against my own strategy or against my own portfolio tactics. So that is where my risk management will come and help me. Even a typical hedge will be in the band of 0 to 20%. This is what we would like to keep it as far as details of the portfolio construct going ahead for. Now, strategic core or a strategic long-term portfolio will be a more or less towards the fundamental driven stock picking approach in itself, which will be overall towards the long-term strategy of holding that particular stock or the security part of it and maintain a steady compounding rather than a short-term momentum to capture with. A typical long or short strategy will be driven predominantly by the event required, or let's say a GST kind of announcement expectation, or let's say about budget announcement, or any kind of monetary policy kind of meetings, or the announcement related. These are the cycles or a sector related or a government trends to be captured with. That is where my tactical long or a tactical trading position or a short positions will come into the picture to capture the momentum in itself. Overall philosophy towards risk management, as I've been mentioned, is to manage the risk is the main crux. The main mantra of this particular strategy is to protect the downside in itself. The key responsibility is to manage the risk within the portfolio at any point of time. Overall, to reduce, to manage the exposure in itself in a rising market, and at the same time, in a falling downside part of it, whether to keep a watch on oversold or a sharply declining markets, to keep observing the different models to work with it and observe, and in terms of controlling the risk and the risk parameters for it. At the same time, other checks like macro exposures towards the stop loss part of it, towards the managing the risk profiling of the beta of the portfolio, standard deviation of the portfolio. These are the checklists will help me to maintain the liquidity part of it, to maintain the leverage part of it, to maintain the capitalization part of it as far as the risk and the risk mechanism is concerned. These are the practices which we will be keeping it in mind while driving this particular strategy in itself. Of course, as I've been mentioning about the purpose is to build a long-term value okay, to invest the opportunistically, to maintain investment into the fundamental approach in itself, to have a forecast for it, to maintain the way. That is where you could observe my strategic long remains to be in and around 55%, but hedging mechanism will help me to control the downside. At the same time, overall culture and a mindset, my guiding principle will help me in terms of don't lose money, and at the same time never forget the rule number one. These are the strategies will help me to have a very disciplined way of managing the funds, and to have a discipline and more or less to get integrate the overall strategy into the portfolio profiling in itself. I think you are aware of the fact the way overall scheme and the scheme objective as I mentioned. So to mention more about the team, Vasav Sehgal is our fund manager. He's sitting next to me right now. He's the one who has joined us from Quant Mutual Fund. He's the one with the expertise into the derivative structures and analytical tools. He's the one who can help us in deriving the different trading strategies with the quantitative techniques. I am come along with, as she has already mentioned, about 25 years of overall experience into the fund management, mainly into the fixed income, money market, and government strategies and the derivative products. It's been quite a long time that I've worked with DSP Mutual Fund as for almost 18 years. I have worked and with a background of ICFI and IIM Calcutta background part of it. Rajesh Bhatia is our group CIO who's already there as a CIO ITI Mutual Fund. He's the one who has managed our AIF long short strategy for last 7.5 years. He's the one who has got almost a 30 years experience, of which almost 18 long years of experience only in managing the long short strategy all across last 7.5 years. He's been with us for managing the AIF strategy. JP sir, Jatinder Pal Singh sir is our CEO with almost 25 plus years of experience. He has earlier worked with Mahindra Manulife Mutual Fund. He has recently joined a year back. I have also joined almost a year, almost a 10 months prior. Vasav has also joined in the last 8, 10 months part of it. Rajesh sir is the one who has been there associated with us for almost 7.5 years. Is the one who has handled AI strategies in itself. This is about the overall ITR group profile that we have shared as far as our data is concerned. Thank you. I think we can open up for the question and answer.
Yeah, Lokesh. Sure. Thank you, sir. Thank you for explaining, in deep, starting from what SIF till your strategy and how you are going to manage. So, participants, I would request you, if you have any kind of a questions, you can put it in a chat box. Meanwhile, I'll start with a very basic, because this is a new product and on a retail space. Probably, I would say, lot many people have not sold AIF. So, just wanted to understand. You said that asymmetric returns is the core thing. So, can you just explain what is the asymmetric returns?
See, it's like if you have invested into a mutual fund as all these long years, it is a purely a long only strategy.
Yes.
Okay, there is like if you invest into XYZ scheme, okay, and the scheme returns will get it aligned with the index or the index performance.
Mhm.
Okay, so it will move the way index has been moving. If it is correction, it will get corrected. Okay, and the returns within that portfolio will also be aligned more or less towards the Nifty returns. Okay, whereby my long short strategy helps me in having a reverse mechanism in itself, whereby in a downward movement of Nifty, I'll be able to protect the downside part.
Oh,
Okay. This is what a different asymmetric return profile, what this is what it called as.
oh,
Okay. In an upward movement, it will move along with the Nifty in itself. As I mentioned in my slide, that it will be a 42% if it is a Nifty, I'll be generating almost same similar kind of return of 44%. But in a downside part of it, we will be able to protect that downside. This is what the combined return is the asymmetric return profile.
hmm,
Okay, risk will be on towards, but then we will be able to protect the returns part of. Yeah,
okay.
I
Yeah.
hope I have explained.
Yes, yes. Thank you. And second,
And
then
just to
in
add further, sorry,
yeah.
it has been demonstrated, it has been tried and checked not only for a particular period of let's say January 23 towards Feb 25. That's a short period of 2 years. But as we can see in that my other presentation, that 8 long years it has been tried and tested. Okay, almost a four sequences whereby it was quite sharp correction and we managed to protect our downside. This is what asymmetric return profile works well in a long investment horizon. Okay, so one additional point that I would like to highlight, Ritu, that the investment horizon of that particular investor has to have to be more than 2 to 3 year or so. Okay. Now, why is it so? Because if you come out with a only with a let's say a 12-month investment, I will participate, which acha lag raha hai kind of stuff, which will never be be fruitful in itself. Why? Because in a sideways movement or a corrective measures or a corrective kind of nifty kind of movement, you will be able to see the kind of better returns profiling compared to the only long only kind of strategies. Okay, that is where we would like to request to all the distributors and investors that the investment has to be at least 2 year and above, because most of the strategies, whether it is a market movement, market cycles, it has been seen and observed that within a span of 2 to 3 years it works well. Okay, but at the same time, for investment strategy also has to have generate a better return. It has to have an investment horizon of more than 2 to 3 year part of it. So that is where the requirement has to be more than 2 and 3 year part of
Okay, okay, wonderful. In the Indian context, if we talk about, mostly we talk about, India's growth. India is a long only kind of a market. How this long short strategies works in India, or probably what's the future of long short strategy in India? So your thought on that?
it. Okay. See, if you observe like PMS and AIF guys, what they are doing is they have all flexibilities as far as investment strategies are concerned, right? You have seen AIF has got the freedom to do all the way up to 200% profile, as far as leverage is concerned. Okay. They can do all the wonders of combinations of doing it in real estate, sometimes in equity, derivatives, FNO, whatnot. Okay. Gold, jewelry, everything that they can trade into, this is what the flexibility can start coming into the SIF part, but with, of course, with some limitations as far as mutual fund limitations are concerned. Okay, you just have to play well within your own means. Okay, you don't have to go too ultra bearish or too ultra bullish. You still can be maintain a 100% portfolio, and at the same time, you still can be able to manage that short strategies as and when it is required to. You still can hedge your portfolio as and when it is required to, because I can allow up to 100% as my hedging mechanism. Okay, and at the same time, I can actually execute these strategies at very flexible way. Okay, now to give you a further example is like in our own Divinity long short scheme, we will be investing predominantly into the large and mid cap stocks. Okay, whereby it will be predominantly a part of FNO segment. Now 220 securities which is allowed, stocks are allowed to trade into FNO, and if you observe, which covers almost a 90% of the market capitalization. Okay, so that is where I'll be able to capture a decent market momentum if it is going up above. And at the same time, I'll be able to maneuver my strategies well within my own means, because these are the 200 stocks which is frequently traded. The volumes have been decent enough. I can hedge my portfolio at any point of time because it is available on FNO. Okay, at the same time, within 200 stocks, at least 80 to 100 stocks are easily tradable, are easily available to trade, and at any point of time I can do it at a larger scale also. Okay, so that is where it will help me to change the portfolio strategies at any point of time. I can change my portfolio construct within a span of few hours itself. So that is where the execution cost will also not be that huge enough. Okay. Now I'll tell you with another example. If it is a small cap kind of exposure, okay, as we all are aware of the fact that the liquidity within the small cap has not been that great, or has not been that comparatively compared to the better compared to the large cap kind of stocks. You can liquidate the large caps at any point of time with larger scale also, whereby small cap has its own limitations. So our investment in this Divinity long short will be predominantly only into the large and mid cap stocks.
As I think ITI is running this strategy since 7 years on the AIF side. So if the number is handy with you, so just wanted to understand out of curiosity how much returns in last 7 years the actually AIF generated through long and the short. Whether short say some kind of a returns has been generated in last 7 years or not.
So this is a particular, like, the presentation is based on my own data points.
Hmm.
Okay,
Okay.
where we have managed last 7.5 years in my AIF itself.
Okay.
Okay, so the downside part, the way it has been protected, it has been observed. Okay, what I can tell you is, like, very difficult to share. If it requires, we can give you the raw data also. But at the same time, in a short kind of strategies, need not to have a too short a position in itself. You just have to hedge your portfolios.
Okay.
Okay, even if you hedge your portfolio, like if it is a exposure, to give you example, in a Reliance cash equity, you just have to hedge it at the right time. Okay, and if it requires, you can unhedge at any point of time. Okay.
Okay.
Now, long only mutual fund strategies is the one which misses this part component, that they won't be able to hedge their portfolios. They are not that quick enough, or they are not allowed to do it up to 100% part of it. Whereby I am allowed to do it all the way up to 100%. As I mentioned, in my bearish kind of strategy, I can hedge the full 55 strategic long exposure at any point of time by way of F&O.
Okay.
Okay, so that is where it makes me, like, my gross exposure. If I am running almost 80%, in the next few hours, I can reduce it all the way up to 30%.
Okay. Okay.
Okay, now I'll give you another example. If it is a long only mutual fund, okay, they are predominantly investable amount of 90-95%.
Hmm.
Observation says, unless and until it is a downside movement in itself. In current scenario, almost all of them are like 95 to 98%. Tomorrow, if things gets corrected, like we have seen it right from September 24 towards that February 25, no one has able to manage or reduce their long only exposure. They have just moved along with the market. They have got corrected along with the market. Their NAVs has reflected into it, and we have seen the returns has gone downward also. As you could see that even 12 months period, it's a single level, single, security level kind of exposure has hit them badly, and at the same time, the returns was generated was as hardly a single digit in itself.
Okay. Okay.
Okay, this is what will make me help me in terms of I can hedge my portfolio, and I can go ahead with a short exposure in itself. Okay.
Okay.
To give you further example, Ritu, as you have mentioned about my AIF part of it, I would like to highlight that the way it has managed, that almost in last 7.5 years, almost 80% of the time, it has maintained a portfolio level of 100% around.
Oh, okay.
Okay, only 10 to 15% of the time we have gone ahead with 110 to 120% exposure, and very few days we have gone ahead with a 200% exposure. Literally, a very few days.
Okay.
Okay,
Okay.
so need not to have a extreme positions at any point of time, but at the same time, you will be able to protect the downside by way of hedging mechanisms.
So can we say, like, it's a just kind of a tool that which you can use in a downside market, probably not all the time, but yeah, on a specific market situations, right?
The market situations can, like, intra-week also can also come.
Yes. Yes.
Okay, so need not to be at any point of time, I always have to be 90-95%.
Hmm.
Okay.
Hmm, hmm.
Even if market gets corrected, let's say from 26,200 towards the next level of 25,500, where we have seen there has been quite support enough in itself. Okay, even if you captured out of 700 point of downward movement, even if you captured a 350 point, also the capturing Nifty 350 is nothing but, even if you protect the 350 point of downward movement by, let's say, by 10 to 20% of the portfolio, will also save to the kitty.
Okay. Okay.
Okay, this is what will help in terms of managing those intra-week, intra-month kind of movement. Now you have seen and observed, as I've been mentioning, like last 12 months, we moved literally at 25,500 plus minus 500.
Hmm. Hmm, hmm.
Okay, so such small movements can also have a better impact on the portfolio, and at the same time, it will accumulate a better returns compared to the Nifty part.
Okay. Okay.
Okay.
But here, if probably if I we will compare from the investor's point of view.
Hmm.
Investors invest in probably on a active funds and all. So there we assume like 2, 3, 5% kind of alpha over a period of time. So
See,
just wanted to understand from the investor's point of view, if they invest in a active funds,
hmm,
for a longer period of time, probably, and they are investing in this long short strategy. So can we say that long short strategy is if you would like to invest for up to 5 years, then you can invest probably in this, and probably longer horizon not?
not really longer horizon. Like you can see, 8 years of track will save,
Hmm.
will have a better returns even compared to the Nifty also.
Hmm.
What I am saying is minimum 2 year has to be investment horizon.
Gotcha. Okay.
Then it can be 3, 5, 8. We have demonstrated for a shorter period of 2 years. We have demonstrated for longer period of 8 years, which justifies to say that it has to have an investment horizon of plus 2 years,
Okay.
2 years and above part of it.
Okay. In a very simple language, लौकिक कौन सा मार्केट सिनेरियो ऐसा होगा जहां पर ये पर्टिकुलर प्रोडक्ट माइट बी अंडर परफॉर्म?
Might be underperformed.
यस.
Uh, you can say if it is like small cap के साथ तो मैं compare नहीं कर पाऊंगा रितु, because
No, no, no. Broader indices.
in
Yeah.
terms of very extreme bullish part of it, okay, it might will have a short period, it might will have underperformed
Okay.
compared to the Nifty. Okay, but that too, if you have like going to see the return profile only for a 3 month or a 6 month, yes, then it will show a underperformance. Whereby for the same Nifty, if it is a comparative analysis for a more than a year or a two, it will get matched to it.
Okay. Okay.
Okay.
So one question
Like
from the.
come tomorrow, if it is like a sharp movement of 5% of Nifty going up, then it might will as underperform for a day, for a week, or a 15 days part of it. But things will get it aligned with it in a span of next 10 to 15 days part of it. So
Okay.
shorter the period, then you can see the underperformance. But the longer the investment horizon, it will get aligned to it.
Okay. So one question from the participants, like what kind of returns we can get it in the from the side in the sideways market or the normal markets probably.
See, what I can say is like if it is a sideways or normal sideways kind of market, it will still beat the Nifty returns in itself.
Okay.
Okay, because this sideways market would be difficult to say that it has generated only a 5% return. I'll be certainly much better than that. That is what I'm saying. Okay,
Okay.
even if it is a sideways, but correction also has happened and generated a minus 2%, I'll be better off by way of a 0% or a marginally positive. Okay, this is what the observation and my track record shows. But of course, everything boils down to the investment horizon. I think there is one more like generate income in sideways or normal market. Now here, I would like to throw a light that it is not a income generation
Mhm.
scheme for that matter. Okay, if you say that I have some cash, I have to deploy it for my son's wedding or daughter's education, 12 महीने में पैसा चाहिए. My request is like try and avoid investing into such instruments, because as I've been saying that it is a capital appreciation or a capital protection product, but not the income generation product. I won't be able to give you that kind of. But if I launch a particular hybrid SIF later on, yes, at that time it will be an income generation product.
Mm. Right. Right.
But this particular my strategy of long short equity is predominantly for the capital protection or capital appreciation.
Okay. 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 And one question is, I think a maximum single security exposure.
10%.
I think you said
So by
8%.
regulation, it is 10%, but by my risk management practice, I would like to keep it up to 8%. Okay. Now to give you a further detailed example, is like if it is 8%, I can be a long short, I can be a only long, I can be only short.
Mm.
Why? Because my only short exposure by single issuer will be capped at 4%, as I mentioned in my portfolio.
Mhm.
Okay, so it could be a combination of only long up to 8%. It could be a combination of long short of 6 and 2 or a 4 and 4 and something of that. But it can't be 2 and 6. Yeah.
Okay. And one question is here now. I think participants are getting active. So one question, so one question here is, what is the ideal long short exposure range across market cycle?
So as I mentioned, it is in the band of tick, tick, one, tick, tick, around 60%.
Around 60% long.
Yes.
Okay. Okay. And what percentage of an investor's portfolio should be allocated to this kind of a product?
See, as I have been saying that it is like a perfect hedging mechanism for
Hmm.
your own portfolio. Okay. Now, why regulator is also coming out with it is like if you don't have an investment of 1 crore, okay. Now people were unable to hedge their portfolios.
Correct.
Okay. Then people have started doing F&Os. They have started playing in commodities market, and I think regulator has also observed the same that people have burned their hands. Okay,
Mhm.
everything. They have lost a decent money because you won't be able to spend much of your time into hedging your own equity level or a stock level kind of portfolios. Okay, that is where a decent particular percentage, let's say what we have been trying to say that at least a 20-25% of your exposure should be hedged well within our own your own equity part of. Okay. So to start with it, it is make sense if you're having a large kind of exposure or a mid cap kind of exposures, you might well start keeping a decent amount into this kind of strategy because I'll be able to capture 90-95% of my upward moment, but at the same time, I'll be able to capture or protect the downside in itself. So that is where a decent 20-25% of exposure will be able to hedge your own equity portfolio for.
So one question is, what is ideal horizon? Probably he mentioned in his talk 2 year plus, and the different market cycles actually works in a two year plus kind of a scenario. So 2 year plus is the ideal investment horizon for that kind of this kind of a product probably. So thank you, Lokik. I think the questions are got over. So thank you so much. Thank you for giving us insights on the SIF and even the long short strategy, which the Divinity SIF basically is it's all about and around it. So thank you for your time, and thank you participants for joining in and be patient with us. Thank you.
Thank you. Thank you, everyone. Thank you,
Thank you.
Ritu.
Yeah.